there is a ton of talk going on about what Goldman Sachs said yesterday. They came out with a report saying that over the next 10 years, they expect 3% growth in the S&P 500. And from what I see, that includes dividends. Now, obviously, we've been talking about this for a while, and we want to get into this to kind of explain where things are. Now, there's more to the story in what they wrote than just 3% growth. Let me show you. Their biggest concern is that the market is so concentrated. They said the premium valuation for the top 10 stocks is the largest since the peak of the dot-com boom in 2000. Goldman said its forecast would be roughly 4 percentage points higher, 7% instead of 3%, if the market were not so concentrated, with a baseline range of 3 to 11% instead of what they have now is -1 to 7%. So they still have a high range of 7%. Now, what I like that they've said here is, they're sitting there basically acknowledging, like, listen, guys, the last 10 years have been awesome. The last 10 years have been killer. The last 10 years were 13%. Since the low of the great financial crisis, the S&P 500 has earned 16% per year, including dividends. That is incredible. But as we teach on this channel all the time, and we teach on our main channel, you've got to remember, the more you pay for something, the less your return. And I'll get into that in further detail in just a few seconds. But here, this is what's scary. In all, they say there's a 72% chance that the S&P 500 underperforms treasury bonds and a 33% possibility that equities generate less than inflation. Now, for those of you out there, the number one thing in your mind probably right now is, that's scary. I need to sell. Don't think that way. And I don't blame you for thinking that way. But I'm going to show you some great data to show that even if you dollar cost average starting today, you can still get great, phenomenal returns. It's all about the habits you put in. But I want to go over real quick what we have said about stock market's GDP, including our video yesterday. But I'm going to go in a little more detail to show you what I'm trying to get across. And you also may be thinking, well, wait a second, Paul, what if I just keep what I have in the market and stop adding to it? Again, I will address that in just a few minutes because the answer may surprise you. So guys, this is my own personal stock market to GDP ratio sheet that I went back to 1929 with the S&P 500 and its equivalents. Guys, we're currently at 114% overvalued. Now, let's go look at our history here. On average, 6.9% returns, not including dividends, going back to 1929. But here's what's interesting. If valuations are better than or worse than 30% undervalued, so let's say -40, -50% undervalued, 11.1%. If it's between 0 and 30% undervalued, 9.5%. If it's over 0%, so between 0 and 30% overvalued, 2.3%. If it's 30% overvalued to 40% flat, 40 and 50 and over, negative returns. Guys, this should come as no surprise. As overvaluation increases, what happens to returns? They decrease. Why? Because the more you pay for a dollar of profit and cash flow, the less returns you're going to make. Let me keep this basic. This iPhone right here, worth about $1,000. If you pay $100 for it, your return is a lot greater than if you pay $900 for it. That's the key there. The same thing, except we get caught up in stories about the economy, about certain companies. When things are rosiest, the future looks best. When things are the worst, the future looks the worst. However, you got to remember that you go back in history, and when you talk about dollar cost averaging and low cost ETFs, you're betting on the US economy. So there's something I have to tell you. If the economy looks so bad that it's going to zero, you should still invest. Because it's either going to zero and your money won't matter, or it's going to rebound eventually like it always does, and you're going to make a killing. Let me go back and show you what has happened in previous peaks and troughs of the market. This is 2005 to 2011 in the S&P. Look at this. About even on the S&P to 38% undervalued. About even 4.6% returns, not including dividends. But look at this shoot up. 11.5 to 13% returns on the S&P at the bear. And guys, at this point, people were worried about actually having a financial system. There were literally concerns about a financial system being shut down forever. Is that realistic? Come on. And look at these returns, not including dividends. Okay, you want a little bit more? Let's go to the other extreme. Market. This is the late 70s and early 80s. This is when inflation was sky high. This is when interest rates were skyrocketing to 13, 14, 15% and more. This is when we had unemployment rates of 10.5%. Literally, we had an oil crisis. We had all these things happening. Undervaluation, 55 to 62%. Look at these returns. 13, 11, 12, 14% returns. Even back here, back in 1979, where valuations were almost as bad, 12%, 12.5%. Guys, as the U.S. economy grows, the stock market will grow with it. As long as you pay a reasonable price. If you're able to get it for a lot less, you're going to make a lot more money. Let me show you a few other data points. This is the tech boom. This is 1998 to 2003. Guys, the internet changed the world. The internet changed the world, in my opinion, more than AI is changing the world. I could be wrong on that one, at least the same. We had never even looked at the internet before. We were able to now talk to each other, email each other. I remember in 1995, Bill Gates talking about email, and people were like, what's this guy talking about? That's how different the world was back then, and it was only 30 years ago. Look at these valuation metrics. We only got to 55% overvalued. We're double that today. And look at the returns over the next 10 years. Now, in defense, we were rebounding from a great financial crisis here, but even afterwards, in 2003, when the financial crisis 10 years later was already past us, 2003 was the bottom, 5.6, 5.7, 5.8%, but we were still rebounding from things. Guys, again, didn't include dividends here. So if you have dividends in here, you're at 7 or 8%. So what am I trying to get at here? Guys, here's the interesting part. Dollar cost averaging will take away all your concerns, and here's why. I went and ran the numbers recently on the S&P 500 and the NASDAQ, and I said, let's say you started at the very peak of the bull market in 2000, the very peak, and you dollar cost average into both the S&P 500 and the NASDAQ. Keep in mind, the NASDAQ fell 83% from this point to this point. That was the NASDAQ. Remember, this is all S&P data. 83%. And if you dollar cost average every single month into it, the NASDAQ would have given you a 13.5% annualized return and the S&P a 10.5% annualized return. So even investing at the peak, getting yourself in the habit of investing at all times will crush returns over the long run. This is above, even the S&P here, this is above historical average. Now, in fairness, we're also at a major market high in terms of valuation. So that's skewing that number. But let's say we take that down and the market goes sideways for 10 years. I guarantee in 10 years, when I do the numbers from 2000 to 10 years from now, if Goldman Sachs is correct and we have a flat market or a slightly up market for the next 10 years, you'll still see a great return. The point here is you need to get yourself in the habit of putting money in and not thinking about it. What I want you to do is I want you to set your goals up the right way so that you're doing ETFs to hit your goals. And everything in excess or any portion you feel comfortable in excess, go buy individual stocks and be patient about it. Buy the right stocks at the right time for you. Don't go running into it. And guys, guess what? I've come to that realization over the last few years as time went on saying, I have more than I need. I'm already hitting my goals. So why do I need to go above and beyond that? So the same thing I'm preaching here to you, I'm actually doing myself. Do I still own individual stocks? Absolutely. Will I be adding ETFs to my portfolio? Absolutely. Why? Because I don't need to hit home runs. I need to hit a lot of singles and doubles and everything will take care of itself. But I want to get myself in the habit of saving every single month and investing every single month, which is what I do now. So guys, I don't know what's going to happen in the next 10 years. All I know is valuations are very, very high right now. So unless GDP absolutely skyrockets for the next 10 years and we have a major economic boom or major inflation, which if we have major inflation, what's going to happen to interest rates? The same thing that happened in the 70s and 80s. Either way, dollar cost average, you'll hit your goals in the long run. And guys, do me a favor, watch yesterday's video to see my recap of the stock market GDP. Thank you for your time.